The TSX opened lower on Friday, then reversed sharply and closed near the high of the day, and immediately the big question started. Circulating is this the beginning of a recovery rise, or is this just the calm before the storm, the first act of a larger decline? If you don't understand the logic behind what are happening right now, the next move could hurt, and I'm not talking about missing a little profit. I'm talking about standing in the wrong place when the market turns and getting run off. This isn't fear-mongering. This is what the data and the price action are already telling us. Most people just hadn't connected the dots yet. Hey everyone, I'm Stock Captain Lady. Welcome back to the weekly Canadian market. Riki, here we deal with reality. Not hayek, we follow logic and capital flows. Not emotions and headlines. Today, we breaking everything down from 3 angles. 1. Is the TSX rally real or just a facade? 2. What are key stocks telling us about institutional behavior? 3. How do we position for what are coming without getting trapped? Part 1. What are really happening with the TSX on the daily chart? The TSX is still trading inside a clear sideways compilation range. Friday bounce came exactly at the bottom of that range and right on the 55-day moving average, forming a long lower wick that tells us buyers stepped in at support. So yes, from a short-term technical perspective, the market looks like it trying to stabilize. Some short-term traders might even see a potential bounce setup, but the daily chart is not the real story. Switch to the monthly chart, and the picture changes completely. Since May, the TSX has been climbing in an accelerating pattern, classic late cycle behavior, and for the past 2 months, we printed back-to-back doji candles at the top, while trading volume keeps shrinking. That 10 a classic topping pattern. Momentum, fading buyers, exhausted, market rising on inertia instead of real demand, and rallies built on shrinking volume are fragile if there no fresh capital pushing prices higher. The structure can break quickly now. At the macro context, inflation remains sticky rate cut expectations keep getting pushed out, growth forecasts have dropped from around 20% to single digits. Corporate earnings momentum is slow when the macro environment weakens. Capital rotates, it moves away from future growth and toward real cash flow uncertain. So what does this mean for the TSX? It means the engine of the rally has changed. This is not a new bull lay, it's an tired rally running on fuel. The market is not taking off. It's a glide, it's a not breaking out. It's a topping out, and herein the dangerous part. Most people still feel comfort. Tops never announce themselves on the crash day. Tops form quietly when everyone thinks it is safe. Part 2. What key stocks are telling us? Let's look at a few names that reveal where capital is actually flowing. First, REIT, T, Royal Bank of Canada. The chart mirrors the TSX. Sideways consolidation, heavy resistance on the top of the monthly chart, sync term downside risk remains. Watch 142.6. Institutions hold banks not because they're bullish, but because they're protecting capital. That's been a defensive move, not an offensive one. Second, ENB and Bridge. This is a post-sell-off recovery move. The first leg of the rebound is already finished, and now the stock is in a waiting zone. There is no strong buy signal yet. Capital is observing, not chasing. Third, show come big reversal candle on Friday, but that doesn't confirm a bottom. It is sitting near the 110-day moving average, and structurally, it could easily flush once more to clear. Liquidity keyed level is $193. If the price holds there, we may get a tactical reversal trade if it breaks down. Growth still is not respected by the market. All 3 names clearly point to the same conclusion. The market is changing engines. We are shifting from stories to cash flow, from speed to stability, from broad participation to selective allocation. And especially in Canada, unlike the United States, tech does not drive the index. The TSX runs on energy, resources, and financials. If any of those legs weaken, the entire index loses balance. If you're still heavily weighted in high valuation, growth, or storyline stocks, you may already be standing in the danger zone. Part 3. What comes next based on the structure? Here are 3 possible paths. Scenario 1, the most likely a controlled pullback. SX retest 29,800 to find real support. Capital reduce risk before redeploying. Scenario 2, a fake breakout oil pushes higher. Temporarily, sentiment improves, and the index spikes to 30,800 to 31,000, but mainly to let institutions sell into strength. Scenario 3, the stress case oil tops. Liquidity tightens, demand weakens, TSX breaks below 30,000 and could head toward 29,000. The trend-wide defensive sectors rallied Friday. Capital is looking for safety, not opportunity. Part 4. So what do we do now? This is not a moment to GAN. This is a moment to position intelligent. The best framework is a two-legged strategy. Leg 1, stable, banks, energy, infrastructure. Companies with strong positive cash flow. Why? In B leg 2, optionality, small tactical exposure to oversold or potential reversal. Safety above, for example. Shopped, but only at structure levels, not emotional anger. The real reversal won't start when everyone is bulls. It starts when leadership rotates and capital flow changes direction. Opportunities come during corrections, not during euphoric green cannons. Investing is not about being first, it is about being on the right side. Final sauce. The TSX may still look stable on the surface, but the engine underneath is chaining. The structure is weakening, momentum is fake. Tops form when people relax. Opportunities appear when people pan. Stay sharp, protect yourself first, then go after probby. I'm Stock Captain, Lady, follow capital. Not Emoy. I'd see you next week.